All right, welcome to The Explainer. Today, we're going to dive into the single biggest reason most traders fail. And here's a hint, it's got nothing to do with their strategy. Nope, it's a battle that's fought entirely in your own mind.
Okay, let's kick things off with a number that honestly stops most people right in their tracks. We're talking about a staggering 90%. That's the percentage of retail traders who lose money and eventually, just wash out of the markets entirely. I mean, think about that. It's a brutal failure rate.
So why? Why is that number so insanely high? You might think it's just bad strategies or a crazy market, right? But the data tells a different story. It's mostly a psychological game. The real battleground isn't on the charts, it's inside your own head. So what in the world is going on in there?
Well, it all comes down to two super powerful primal emotions that basically hijack our brains: fear and greed. I mean, once these two take the wheel, even the most brilliant trading plan becomes pretty much useless. So let's break down how each one of these really works against you.
And what's crazy is how these two opposites team up to just completely wreck your discipline. You've got greed, right? It's pushing you to take on way too much risk, to ignore your own rules, like stop losses, which are supposed to be your safety net to prevent huge losses. You're just chasing that quick profit. And then on the other side, you've got fear. Fear makes you hesitate. It makes you miss out on perfectly good opportunities, or even worse, get scared and jump out of a winning trade way too early. The end result? You feel like you've completely lost control of your own decision-making.
Okay, so these raw emotions get even more powerful because of something called cognitive biases. Now, these are basically just mental shortcuts our brains take, especially under pressure, and they can really cloud our judgment. Let's look at 4 of the most common, and frankly, most destructive traps that traders fall right into.
First on the list is overconfidence bias. You know the feeling. You have a few winning trades in a row and suddenly you feel invincible. You think you've cracked the code, you've figured it all out, and that's when traders start taking dangerously large positions, ignoring their own risk limits, and basically just throwing their analysis out the window. And that, almost always, is how they give back all their profits and then some.
All right, next up we have confirmation bias. This one is so human. It's our natural instinct to look for information that confirms what we already believe. So if you're convinced a stock is going to the moon, you'll gobble up every article, every tweet, every analyst report that agrees with you, and you'll just conveniently ignore all the glaring evidence that says you might be wrong. It's a recipe for reinforcing some really bad decisions.
Then there's this big one, loss aversion. Psychologically, studies show that the pain of losing something feels about twice as strong as the pleasure of gaining that exact same thing. This is a huge driver of terrible trading behavior. It's the reason why so many people will just cling to a losing stock, praying for it to come back, because the act of clicking sell and making that loss real is just too painful to face.
And last but not least, we've got recency bias. This is when you give way too much importance to what just happened. If you just had a string of losses, you become timid and overly cautious. If you just had a bunch of wins, you get reckless. See how that works? Both of those reactions totally sabotage the discipline you need for a solid long-term strategy. So this brings us to the big question. How on earth do you escape these traps? Okay, the solution, it's not a new indicator or secret strategy. It requires a complete, radical shift in how you think. It means you have to stop trying to predict the market and start thinking purely in terms of probabilities. And this whole framework comes from a legendary book in the trading world, Mark Douglas's Trading in the Zone. I mean, it's basically the Bible for traders who are serious about mastering their own psychology.
So here they are, the 5 fundamental truths of trading. And when you truly internalize these ideas, everything changes. You stop looking for certainty in a world that is fundamentally uncertain. You accept that on any single trade, literally anything can happen. And instead, you start trusting your statistical edge over a whole bunch of trades. You start thinking like a casino owner, right? They don't know if you're going to win the next hand of blackjack, but they know that over thousands of hands, the math is on their side.
But look, just changing your mindset isn't enough. You need a practical, step-by-step operating system to put it into action, day in and day out. This is the real path to building that unshakable discipline. And here it is, the trader's operating system. These 7 principles of consistency are what take trading from being an emotional roller coaster to a disciplined, data-driven business. This isn't just, some friendly advice. This is your personal rule book. This is what you live by for every single trade you even think about taking. It's all about flawless execution, not trying to be a fortune teller.
Okay, so you've got the mindset, you've got the operating system, but how do you actually stick to it when the market is going crazy and the pressure is on?
Well, you don't rely on willpower. Use concrete, non-negotiable tools to enforce that discipline and manage your risk. And I want to be really clear here. These tools are not optional. They are the absolute bedrock of psychological control. A written trading plan? That's what stops you from making stupid emotional decisions in the heat of the moment. A stop-loss order? That automatic exit point we talked about? That's your safety net. It's unbreakable. And a trading journal, where you log and review every single trade? That's how you become your own coach. It's how you learn from your wins and, maybe even more importantly, from your losses.
So why is all this so critical? Because every little psychological slip-up has real cold, hard cash consequences. Just look at this table. In trading, your position size is measured in lots, and the price moves in tiny little bits called pips. Now let's say greed takes over, and you take a huge standard lot position. A tiny 10-pip move against you could cost you $100. Poof! Gone. But if you managed your emotions and took a smaller, more responsible micro-lot position, that exact same market move would only cost you $1. See? Your mindset directly, and I mean directly, impacts your wallet.
So you see, in the end, becoming a successful trader isn't about finding some magical holy grail strategy that never loses. It's about this quote right here. It's about really, truly, deep down in your bones, accepting that the market is all about probabilities, and then having the iron will discipline to just execute your plan flawlessly over and over and over again.
So, there you have it. We've walked through the problem, we've uncovered the psychological traps, and we've laid out the entire framework for a solution. The path to winning in trading isn't about conquering the market. That's impossible. It's about conquering yourself. You have the blueprint now. The only question left is, can you master the person in the mirror? Thanks for joining this explainer.